If you're already hosting or investing in short-term rentals, here's some news you're going to love. In July, Congress dropped a financial gift for Airbnb owners. And let's just say it's a big deal. The One Big Beautiful Bill Act, signed on July 4th, 2025, just reshaped the STR tax landscape. We're talking the return of 100% bonus depreciation, a now permanent 20% QBI deduction, and massive opportunities to front-load your deductions and build long-term wealth. If you're running your STRs like a business, and it's 2025, you should be, this is your moment. Let's break it all down and show you how to make the new tax code work for you. Remember bonus depreciation, that juicy deduction that let you write off big purchases in year one? It's been slowly fading out of existence, until now. Thanks to the One Big Beautiful Bill, 100% bonus depreciation is back. That means that from now on, if you furnish, renovate, or upgrade a rental, you can deduct all of it in year one. New couches, deducted. That $10K HVAC upgrade, deducted. Fancy lighting, smart locks, new appliances, you guessed it, deducted. And here's where it gets even better. If you run a cost segregation study, you can break your property into parts and accelerate even more deductions. Imagine buying a $1.2 million property and uncovering $400,000 in assets you can deduct immediately. That's not a pipe dream. It's now reality for investors using this strategy. Remember, depreciation creates paper losses that can offset real income. Even W-2 income if you meet material participation rules. This isn't just tax deferral, this is tax strategy at full throttle. Now let's talk about QBI, the Qualified Business Income Deduction. This little known gem lets eligible STR owners deduct up to 20% of their net rental income. And as of 2025, it's now permanent. To qualify, you just have to treat your STR like a business. That means logging 250 plus hours on rental services like cleaning, messaging, maintenance, etc. Keeping records of your time or aggregating your properties to hit that threshold. A quick clarifier, no, you don't have to do it all yourself. If you coordinate teams or manage remotely, it still counts as long as you're actively involved in tracking your hours. And if you're making real money, even better. Just be mindful, this deduction does phase out at a higher income level, around $197,000 for single filers and $394,000 for joint filers in 2025. But for most hosts, QBI is now a predictable, long-term tax benefit, and it stacks beautifully with depreciation. This is where the real magic happens. When you combine 100% bonus depreciation, QBI, and non-passive status, aka material participation, you unlock a tax trifecta. Here's the deal. If you meet IRS rules for material participation, your STR income becomes non-passive. That means you can apply those juicy depreciation losses to any kind of income, W-2, business, whatever. You reinforce your QBI eligibility and you turn your rentals into real operational businesses, not just passive investments. Think of it like this. You're not just hosting, you're running a high-performing hospitality business with financial efficiency baked in. And if you're reporting your income on Schedule C instead of Schedule E, that might actually work in your favor now. Sure, Schedule C means paying self-employment tax, but if you're deducting 20% through QBI and writing off 6 figures in depreciation, that trade-off might still put more money in your pocket. Just don't make that switch without consulting your CPA. It's all about strategy. All right, let's talk action steps, because tax savings only matter if you use them. 1. Plan major upgrades or purchases this year. With 100% depreciation back, every dollar you spend furnishing or renovating can be deducted up front. 2. Talk to your CPA about cost segregation. Whether you're buying or improving, this strategy uncovers assets you didn't know you could write off. Yes, it costs money, but the return is often massive. 3. Reassess how you report income. Schedule C might not be for everyone, but with QBI and bonus depreciation in play, it's time to ask the question, Could reporting as a business actually save you more? 4. Start tracking your hours. Like today. Even if you're not sure you'll hit the 250-hour mark, detailed logs give you flexibility later. You can't go back in time and recreate this stuff. 5. Revisit your business structure. Thinking about an LLC? Now's the time. Entity structure can make a big difference under the new rules. We've got a full guide if you're weighing your options, and I'll link it below in the description. 6. Use AirDNA to model smarter investments. Don't make tax moves in a vacuum. AirDNA's revenue calculator plus market level data let you forecast cash flow, benchmark performance, and invest where it actually makes sense to spend. The changes from the One Big Beautiful Bill are more than a tax update. It's a call to level up your STR business. You've already got the property, now it's about running it smarter, keeping more of what you earn, and building real wealth over time. So whether you're buying, renovating, or just optimizing your tax strategy, make sure you're not leaving money on the table. If you liked this video, make sure to give it a thumbs up and subscribe for more STR growth tips. Drop a comment if you want us to break down cost segregation or QBI in more detail. And if you're ready to go even deeper, check out AirDNA to back every decision with real data-driven insights. I'll see you in the next video.